Lower migration due to closed borders could have a disastrous impact on the inner city unit property prices. In this video, I'm going to talk about how the inner city unit markets declining could lead to Australian housing market crash. Dwindling migration is set to drag Australian population growth to a 103-year low, with a potential disastrous result for the Australian housing market. Property research group CoreLogic warned the slowdown would have a disastrous impact on the construction sector, rents, and off-the-plan apartment sales. CoreLogic normally have a bias towards the positive with the data, so if they are saying a downturn is likely, you better believe it's possible. Head of research Tim Lawless said the construction sector was particularly exposed. With fewer overseas arrivals, this was going to put downward pressure on demand and would stall new projects. Lower migration is having an added effect on the unit market in the inner city suburbs, where migrants normally make up a bigger share of the rental market in the inner city unit areas. Falls in rents will also put downward pressure on prices, as investors won't want to buy these units because they think they may have a problem trying to find a tenant. Not to mention the poor construction quality of many of these apartment buildings, with some sinking and some finding cracks or mold and having to be evacuated. This is creating a huge risk for property owners or investors that brought apartments off the plan, where now they are coming to settle and the bank may value the unit lower than the purchase price, meaning they have to pay up the difference or risk losing their deposit. But Mr. Lawless said the impact would not be evenly spread, with Melbourne and Sydney being the worst affected. Nearly 85% of immigration last year went to the major capital cities, and 3/4 of that went to Melbourne and Sydney. The impact of a sharp fall in immigration is already being seen in some key inner city unit areas, where advertisement listings have more than doubled. The rise in available rental stock in these areas are already weighing down on rental income. Every capital city is showing a larger fall in unit rents relative to house rents, with a more significant difference in Melbourne and Sydney. Sydney and Melbourne unit rents were down an average of more than 4% since March, according to CoreLogic's data. With rents reducing the ability of landlords to service their mortgages, there could be more distressed listings within inner Sydney and Melbourne. A higher proportion of new units may settle with a valuation lower than the contract price. This would have an even bigger effect on property investors that have multiple negatively geared properties. Many of the inner city areas are toward the end of a surge in new apartment supply. Many of these yet to be completed projects will settle while rental vacancies remain high and rents are falling, which will put downward pressure on property values. ABS building activity data showed there were more than 50,000 units under construction across New South Wales at the end of March, and over 45,000 across Victoria. Lower population growth would affect the market for some time. The outlook for overseas migration remains highly uncertain, and depending on international borders reopening. Recent forecasts from the Treasury indicated annual population growth across Australia is set to slow from around 1.4% pre-March to 0.6% through the 2021 financial year. That implied Australia's annual population growth will reduce from around 350,000 in 2019 to 154,000 over the year ending June 2021, a reduction of 56% relative to 2019 levels. This would be the lowest rate of growth since 1917. That's right, the lowest since 1917, so immigration won't save us this time. In the past downturns, the Reserve Bank was able to drop interest rates to stop prices from falling, but with interest rates already at 0.25%, they won't be able to use that tool this time. And many people said the upper end of the market won't be affected because households don't have to sell, but CoreLogic data showed that house prices have actually dropped 7% in the upper end of the market in Melbourne, and they've dropped 3% in the upper end of the market in Sydney. So the upper end at the market right now is being the most affected. What you have to understand is the Australian housing market isn't just one market. Every capital city has its own market, and every suburb in that capital city also has its own market, and they all move at different times. Now, traditionally what happens is the upper end of the market moves first, and then that causes a ripple effect into the outer suburbs and lower ends of the market. Now we're in September, JobKeeper is going to be reduced from its $1,500 a fortnight payment to $1,200 a fortnight. Not only this, but people that were part-time working less than 20 hours before were actually getting the full $1,500 payment, but that is now going to be reduced to just $750, so a lot of money in the economy is now going to be withdrawn, and those people that were using that to cover rents are now going to struggle to pay the rent, and this is also going to affect mum and dad landlords. JobSeeker is also being reduced from $1,100 a fortnight to $800 a fortnight, and then they're going to relook at it in December, and they may even drop it again. So all those people that are now getting kicked off the JobKeeper program are going to get put on JobSeeker, and again, a lot of money is being taken out of the economy. So if you thought that the government will step in to save the market, it doesn't look like they're doing that right now. Something we also have to keep an eye on is the eviction ban. The eviction ban has been extended, so we may see some landlords that haven't been able to collect rent from tenants and now think that they may have no chance of capital growth, or they may lose their equity in their properties if they hold on, may just give up and say, look, stuff this, they're not paying rent, I'm not going to get any capital growth, I'm just going to sell. Now that it is September, we are heading into the spring selling season, and traditionally spring sees a rise in listings, but experts are predicting this may be a quieter one. But they are saying that later in the year and early next year, there will be more distressed properties come onto the market as JobKeeper and JobSeeker is being reduced, and now it has been 6 months since March where people have put their mortgage repayment on holidays. So banks are going to have their 6 months check-in, and there may be more pressure on customers to start repaying because banks' profits are coming under pressure and shareholders are wanting to go and get their sweet dividends. Another big problem that could happen to the property market is the huge amounts of small businesses in Melbourne and Sydney that could go out of business or may decide to sell their investment properties to keep the business going, something that the media is not talking about, but we are seeing to see more reports of small businesses struggling and that may never be able to reopen after being shut down for more than 6 months. Now, I know you guys may be thinking, oh, here we go, just another doomsday saying the property market's going to crash like they all said before. But now we are actually in real trouble. Australia is officially in recession with GDP falling by 7% in the June quarter, the largest fall on record. Now, to put that in perspective, the largest decline before this was in 1974, where GDP fell just by 2% in the June quarter. So this is more than 4 times that. So what does this mean for everyday Australians like you and me? And full disclosure, I'm a property owner too, so it would be in my interest to spook the property market, but actually care more about the economy overall and the Australian people than just increasing my home value. So what this means is, although property prices haven't fallen hugely before, the tools they use to save the market, like lowering interest rates and giving out cash handouts to first home buyers, they've already used those, and there's something called the law of diminishing returns, meaning if they just keep doing the same thing, it's not going to have as big of effect as last time. So what can we do? Now what I'm doing, this is not financial advice, but what I'm doing is I've paid off high interest debt, I'm increasing my emergency fund, and I'm waiting for opportunities that may come ahead. Now, you could also want to diversify your income. You can do this by creating a side business or side hustle. You can also get another part-time job or even create a YouTube channel like me. At the end of the day, we're in very uncertain times, and I know no one can predict the market, but things are not looking good. At least if you follow these steps, you'll be in a much better position than the average Australian who has no savings and puts everything on credit cards or Afterpay. For all my loyal viewers and subscribers still watching, you're awesome. And if you haven't already, smash the like button for the holy YouTube algorithm and comment your thoughts below. What do you think will happen to the market? And if you haven't already, subscribe for more awesome content on property market updates, the economy, personal finance and investing. And if you haven't gone and watched all the rest of my videos, go watch them all right now.